Farmland is one of the most attractive asset classes out there in today's environment. Supply of productive acreage is actually shrinking worldwide, pulling land prices higher over time. And demand for agricultural commodities is robust and growing, heavily insulating farm income from rising inflation. So, what are the key factors and trends you need to know when considering investing in farmland? And can you do so without having to buy an actual farm and becoming a farmer yourself? Well, we invited farmland expert Edward Hargroves to answer these very questions at the Wealthion conference held a few months ago. And don't worry if you missed the conference, as we're making our interview with Ed available to you right here, right now.
But in spite of size and in spite of age, it's still relatively unknown. And I think that's really a function of the ownership matrix. That 98, 99% of farmland in the US is owned by individual farmers, farming families, and not by institutions, unlike stocks and bonds, etc.
Well, I'm so happy to be interviewing this next guest to talk about an asset class that is, I think, of great interest to most people viewing this conference, but perhaps an asset class that they may know, might be one of the ones they know the least about. I'm talking about farmland, and today we are talking with Edward Hargroves, who is a co-founder and partner of Goldcrest Farm Trust Advisors, which built and manages the farmland portfolios of Goldcrest Farm Trust REIT, which is a private farmland REIT with over 600 million in long-term capital. He is responsible for farmland property deal evaluation and execution, portfolio construction, capital markets, finance, fund management, administration, research and strategies, and investor relations. Pretty much everything related to running it. Prior to Goldcrest, Edward worked for the team that co-founded AgCoA, or AgCoA. Edward, you can correct me on the correct pronunciation of that, but why that's important is that is the largest farmland private REIT in the United States. I've asked Edward to join us today to explain the fundamentals of investing in productive farmland, as that's an extremely appealing asset class today to many hard asset investors. Edward, thank you so much for agreeing to speak at this conference.
Oh, Adam, thank you for having me. And that laundry list of, that's what happens when you're part of a small team. You wear lots of hats.
Wow. All right. Well, look, let's get into the meat of the discussion. But just to kick us off, so clearly you're a very experienced investor in real estate. Let's just begin with an understanding of the advantages of farmland as an asset class. Why should people invest in it?
Well, look, if you're going to start from the beginning, it's the oldest asset class in existence. And that makes sense because, it's obviously the primary source of food production for most people over the course of history. It's also a very large asset class. Within the US, it's on the order of $2.5 trillion in size, depending on what types of crops you're including. But in spite of size and in spite of age, it's still relatively unknown. And I think that's really a function of the ownership matrix, that 98, 99% of farmland in the US is owned by individual farmers, farming families, and not by institutions, unlike stocks and bonds, etc. Now, institutions, with this 1% to 2% ownership, you are starting to see, influx of capital coming into the market. Case in point, firms, like the one that I'm a part of, because of attractive attributes. But typically, when you see fresh capital moving into a market, particularly coming from a low institutional base, that often bodes very well for the asset class going forward. Now, why would institutions want to invest in this asset class? Well, principally, it's demonstrated very strong risk-adjusted returns over most any period in history. So strong returns, low volatility relative to stocks and bonds, a high Sharpe ratio. It's outperformed meaningfully during recessions. I believe since World War II, it's really only had maybe 6 or 7 down years. And that also makes sense given that it's a tangible real asset, cash flowing real asset that obviously has linkages to food production. You still need to eat during recessionary years. It also acts as a great portfolio diversifier. It's it has low or negative correlation with all these other asset classes, stocks and bonds, so it fits very well into a portfolio. But where it does have correlation and strong correlation is with inflation, which is obviously a theme that is very front and center these days. So there's also a very compelling long-term macro backdrop as well. Over the next 30 years, we're going to add 2.5 billion people to the world. That's a 30% increase over today. And this growth is principally coming from the emerging markets, Southeast Asia, Africa, key importing nations for food. They are unable to satiate that demand themselves. And so, what's important here is there are only certain places in the planet that have optimal conditions, be it soils, be it climate, weather, infrastructure that can provide that food. The chief, most important one, the blue chip of the world, principally being the US. It is, which is the largest producer, exporter of the greatest amount of crops in the world. So, I think that's something that's very supportive going forward as you see this continuous uptick every year in demand. Where are you going to find that production? Certainly, you can find it through if you add acres, but that's very hard in a world where we're starting to get more concerned with ESG, deforestation, etc. And so it means that you're more reliant on increasing the productivity of that land. But every year, you still have to know that you're going to add 70 million more people that need to be fed.
All right, great. So all excellent reasons. And you kind of provided already a nice segue into my next question, which is sort of, what are the major trends that you see driving the future of agriculture, from an investment, with an investment viewpoint? So you already talked about population growth.
Yep.
You also briefly touched right there on the end of, land, they're not making any more of it. And, we're losing land to development and droughts and stuff like that. So it's not like there's going to be the risk of a massive new supply of farmland coming online, anytime soon. Anything else? I guess there's weather trends. I don't know if that plays a huge issue, but I know right now in the States, at least, right, we're having a pretty sizable drought in the American West. I live in California, which is having one of its worst droughts ever. And we've got the whole Central Valley, which is where a ton of different products, the majority of a ton of different food groups in the US are grown. So does weather play a role? Do geopolitics play a role? You mentioned inflation. That may play a role in terms of demand for the pricing. There's the trend towards more organic eating. I don't know if that has a real material impact or whatnot. But anyways, I just rattled off a bunch of ideas. What ones have, kind of occupy your focus as somebody who invests on a daily basis in the space?
Yeah, no, like all those trends are very real. Some of the trends that I'm seeing, obviously I touched on that influx of institutional capital that's coming into the market and why it's coming in. But just to put, some better, framing around that, when I first entered this space, 15 years ago in 2006, there were probably on the order of 15 to 20 farmland investment managers in the world. And today, they're probably 3 times that in the US alone. So obviously, over the last 15 years, meaningful growth, but we're going to continue to see, new investment managers coming into the space. If only this week I saw a new, very large Canadian pension fund, Caisse Depot, announcing that they want to put, $1 to $2 billion of capital out in US and Australian farmland over the next 5 years. And you have lots of data points like that. You also mentioned, ESG, and I think that's very front and center across most every asset class. But if you're going to break it down by these particular initials, on the S part, the social part, I think we're starting to think, pay greater attention to understanding and demonstrating, where your food is being produced, what were the inputs that are going into it, what chemicals are going into it, what's your carbon footprint going forward, what's your carbon footprint of your supply chain, so scopes 1, 2, and 3, what's the nutritional content. We have a great battle with obesity in the US. majority of COVID-related deaths, were people who are overweight. So I think nutrition and understanding the source of your food is a particular theme that we're starting to see more of. And maybe that takes you going down, the sort of regenerative agriculture side, less of these sort of toxic chemicals, etc. Equally climate, which you touched on, and very important from that standpoint as well. So understanding that, if we are all going to participate in slowing global warming, it has to come from, everyone has to play their part. Agriculture has really had a bad rap, and perhaps rightfully so, as being a big emitter, and a producer, that's resulted in some of this climate change. So as you move to, I think you're going to start to see, greater attention being paid to how can you do more sustainable farming, not only lessening your emissions, but hopefully also starting to sequester some of that carbon, going down that regenerative farming route. So I think, another point is really on the topic of food security. I really feel like COVID, it kind of opened Pandora's box in terms of the way that individuals, companies, governments view food. And I think there's been a behavioral change there. So heading into COVID, the US and the world had really gone through a period of bounty, plenty of surplus inventories around the world. But when COVID happened, you started to see border closures, you saw bottlenecks, within countries. And as a result, for many different crops, you started to see increases in prices, like rice prices went through the roof. And as prices started to increase, you saw countries, emerging markets, which their currencies had been crushed. They were looking to export more products because they're being paid in dollars, which resulted in their own governments saying, okay, we want to keep this food in our own country. So they imposed export tariffs and restrictions. There were 17 plus countries around the world that did this, which further exacerbated price increases, etc. And so it's, on the one hand, if you're an exporting country and you're seeing prices rise, but you're keeping food, within your own country, that's okay. But if you're a massive food importer, that's certainly a big concern. You have a lot of the Middle East countries which have young populations, which are all big food importers. They have a history of civil unrest when wheat prices and bread prices start to go up, and you can't have food when you don't have sustainable food within your own country. And that becomes a very big cause for concern for governments. It's the chief recipe to seeing your government topple from that side. So I think that, with COVID in the rearview mirror now, or hopefully more in the rearview mirror, and frankly, even the Arab Spring, only 10 years ago, it's amazing how we forget, what happened, back then. But you're going to have companies and you're going to have governments really start to focus more on, as opposed to just-in-time inventory management, just-in-case inventory management. Make sure that you have sort of more surplus inventories than you would ordinarily hold. I think that's going to be a big theme going forward. Doesn't get a lot of press.
All right, really fascinating. And to restate it, and correct me if I'm restating this incorrectly, it sounds like food going forward may need to be a little bit more expensive, sort of in the way that the organic movement has said, hey, look, organic food is always going to be more expensive than conventional food, but it's for a good reason, right? It's healthier, it treats the land better, et cetera, and it's a price that we should pay for the health of our bodies and our soils. You're basically saying, look, you're probably going to see, food supply chains in a lot of countries change so that they do probably have a slightly higher cost basis, but it's to add resiliency to the system. So on average, our food might get a little bit more expensive, but hopefully we're going to have a lot more dependability on those supply chains for those investments that we're making. Is that accurate?
Yeah, you nailed it. And I think that you're seeing plenty of CEOs of various CPGs talking about that as well, that we're never going to be caught short again. we need to change, how we manage our supply chains.
All
I'm
right.
I'm just taking it to a sort of national level as well.
Okay. So I want to now move to the question of, what is it that you look at in land when you're considering buying farmland? What makes an attractive property? But I want to continue pulling at this thread that we were just talking about, it's sort of about resilience. And I imagine one of the most important factors when it comes to buying good farmland is getting good access to water. So if you can, sort of talk about the key role that water plays as well in your land selection process.
Sure. Well, look, getting or waxing philosophically for a minute, 71% of the earth is covered in water. But of that water, 97% of it is in oceans, and only 3% of that is fresh water. And of that fresh water, the vast majority of that is inaccessible. It's stuck in polar ice caps, in the ground, in the atmosphere, etc. And so we have, very little available, usable fresh water, from a grand scheme of things. I once heard a stat that if you viewed, global water supply, if you said that was worth 100 liters, that usable water supply for fresh water, for drinking, for growing of crops would amount to half a teaspoon. So 100 gallons, we have half a teaspoon that we're dealing with. Benjamin Franklin, once said, when the world runs dry, we'll really know the worth of water. And obviously, it is, it's the lifeblood of agriculture. Without water, there is no crop. And you see this, if I'm looking at this from a macro perspective, let's take China as an example. China has 20% of the world's population. It's got 9% of the world's arable land, but only 6% of the world's water supply. But if you drill down further into China, to northern China, they have two-thirds of Chinese farmland is in the north, and half their population, but yet they have very deficient levels of water. There's a term called, the international definition for water stress is having access to 1,000 cubic meters of water per person per year. And in China, they have a fifth of that access. So what does that mean? It means that they've got a lot of people, but they don't have enough water to grow their own crops. So they have to look elsewhere around the world, places that do have water, to send them those crops. The U.S., is one of those key areas. So when I'm thinking about, massive exports that we're sending over to China, really think of that. If you're sending a soybean or corn over to China, that's really a proxy for water from the beginning. Do you want me to go into anything else on water, like in terms of?
Sure. Well, how about let's talk about sort of water rights. Personally, I've interviewed the managing director of Farmland LP, which is a much, much smaller fund than yours, but it's very sort of, sustainable agriculture focused, and really getting to know how that fund is run. I almost think of it as water rights LP versus Farmland LP, because that seems to be the primary selection point for why they're picking their acreage.
So, so when I drill down into water, there are two different routes that you can take to invest in farmland. One is you can say that you're going to be reliant on Mother Nature, and you believe that, in any given year, you're going to get enough water on your dryland farm in Iowa where it's not irrigated. And maybe it's a little bit of hope for the best, but you like the track record and history that you have grown great crops in that area just through natural rainfall. Or there's a focus on actually having irrigation. And within the US, there are different ways that you can access this. You mentioned in the Pacific Northwest, it's, Idaho, for instance, is very much of a desert, and you're drilling wells and you're getting sort of groundwater, and you want to make sure that you have sanctity of water rights, that you have senior rights relative to other farms. And that's how you sort of get comfortable with the strength of your water for that farm. But you go elsewhere in the country, and it's a different game. You go to the Delta, and you have a lot of rivers, you can sort of, pardon the pun, but you can, put your finger in the ground, and you often get access to water. It's free, and now it's just a question of managing that infrastructure, the costs to get the water from the river, surface water, or if you have wells, they're probably pretty cheap to drill, and maintaining that irrigation infrastructure, the capex behind that. So, water, you can play it two ways. Like, agriculture really is a water play, but do you want to have that ability to go to bed and sleep at night knowing that you're going to get water on, you're going to be able to water your crop, but perhaps you paid a little bit more for it. You're paying for that water. You're paying for the upkeep of your infrastructure, or you're waiting for Mother Nature, and you see where that takes you.
Okay. All right. Well, look, let's get into the nuts and bolts here. So now your fund that you run is for big institutional players. It's not open to retail investors like the folks that are watching this video. But do you have thoughts, as just sort of an expert in the space, of options for smaller investors to get into this asset class, whether it be through publicly traded ETFs, private funds, private REITs, crowdfunding sites like AcreTrader or Farm Together? Do you have any general advice for people that are interested in investing in farmland, but they're not a billion-dollar institution?
Sure. Well, look, I think one of the reasons that I've made this a career on the institutional side is my belief that farmland is a very capital-intensive way to invest, and so by that nature, there is that inherent moat, and that was something that is attractive in my position. But there has been that advent of these fractional ownership firms. You mentioned AcreTrader, Farm Together. I can't really speak to the companies in question, their management teams, their fee structures, their pedigree, how they underwrite farms, etc. But from an actual access point to the retail investor, I love the idea of fractional ownership, and I think that's it provides nice access to being able to invest in this asset class. That said, I would say that if you are going down this route, perhaps if you had $50,000 to invest, spread it out over 5 properties, for instance. So if you're buying into one property, you're not going to be diversified, so you're at the mercy of that operator or that climate, those soils, and whereas if you can put capital into different properties, that feels a little bit better. That plays into the route of some of the publicly traded farmland companies, which obviously have that natural diversifier, but they being publicly traded, they start to have more correlation with what's going on with the actual ag markets. So they sort of trade more in line with crop prices. And when you invest in farmland, you want to be free from the daily mark of if corn prices went up or down because it rained, etc. You want to have something that's a little bit more stable, that latency that you believe that the trends are going higher, rather than, hey, your farm is worth $1 million today, it's now worth 500 grand. Like that, those aren't ways that that you can sleep at night. If you want to, outside of investing in these areas, like you can get exposure through buying commodity ETFs like DBA, which is a construct of different crops as part of that makeup. And as I mentioned, obviously, corn prices, soy prices, they're a proxy for water, and one would believe that if corn prices are going up, the farmer's making more money, and therefore the land that produces that crop also goes up. So there is obviously that linkage, and it's a proxy for investing in farmland. But it's obviously it's reliant and it's levered to what's going on, the vagaries of the daily market. So it's not really a perfect play.
Got it. Okay. So just to sort of recap, there are huge institutional funds like yours. There's private funds like the Farmland LP model I mentioned briefly earlier. Those usually have pretty high minimums. Then there's publicly traded ETFs, which you talked about super briefly, but I know Gladstone is a big one. If there's any others of note, feel free to chime in. And then beneath there, you've got these sort of small fractional ownerships models like the new Acre Trader and Farm Together. And you're right, you said you couldn't really speak too much to how they're run. One of the important things about those is they really are new. So it's kind of an interesting and to some people exciting model, but we don't really have any exits yet coming from those. So nobody can really talk definitively as to how they perform, because most of the projects that they're raising capital for there are 3 to 10 year projects, and I think those companies have only been raising capital for the past 2 years or so. So you have that, and those are buying into the farmland side of things. Of course, you could always go buy your own farm, but I think most people are interested in this discussion because they don't want to have to become a farmer themselves. But you've said, separate from the farms, there's also the commodities, the products that come off those farms, and you can invest in those. And I think you mentioned DBA, and there's a number of ETFs out there for specific types of commodities. All right, well, Edward, thank you so much for sharing your incredibly deep expertise in this space with us. As we begin to wrap up here, is there anything else that you think the curious-minded retail investors should know about farmland before potentially cutting a check to one of these solutions that we talked about?
So I think, well, right now, agriculture markets are in a really interesting place. And if I was just to, maybe take a step back for a while, pre really mid 2020, we, for the last 6 or 7 years, agriculture across the world and commodity prices have been depressed. Pretty much every headline, every headline was negative. Lots of headwinds across the world. You had periods of optimal weather during growing seasons across the whole, for the most part across the whole world. You had periods of surplus, bountiful stocks that seemed to grow every year. You had manufactured demand side issues, be it trade wars, being, with our key buying partners, Mexico, Canada, China. You had African swine fever in China, which resulted in the decimation of their hog herd and resulted in less imports. You had, something that impacted the biofuel side, ethanol and biodiesel. You had the Russian-Saudi oil price war. So when oil prices went negative, that pulled down the energy complex within agriculture commodities. So lots of negative things going, in recent years. And yet farmland prices remained pretty resilient, even though the farmer, was sort of more cash strapped than he had been. But I think midway through 2020, the narrative has started to change. We were heading into last year with the expectation that we were going to have, bin busting, crops, within the US. Weather started to change a little bit, and what was, set up to be a record crop turned out to be a very sort of average one. That then started to lead into other weather events that we saw around the rest of the world. La Nina, case in point, you saw droughts in the FSU in Russia and Ukraine, which impacted their wheat and corn crops. You saw droughts in South America, Brazil, Argentina, which delayed their planting season, which left the US export window open longer. And so you started to see these murmurings of supply side issues for the first time in a while. And I feel like in a world where we have climate change, that's the more likely route that we will go. That there's a greater expectation for more extreme and more prevalent weather events going forward than there has been, but we just didn't really see that in recent years. It was sort of like we kept getting lucky and having bumper crops across the world, and if there was a weather event, it was happening when a crop wasn't growing. But now you've also started to see the reemergence of massive demand. China, for really since 2016, had been in a period of destocking, selling out of reserves to satiate some of the domestic demand internally in lieu of importing extra crop. Between 2016 and 2020, they drew down their corn inventories from 230 million tons to 188 million tons, so 42 million odd tons, which is basically close to the equivalent of the amount of corn that the US exports in any given year. So a vast amount. They then, I think with COVID in the backdrop and that fear of, food security and making sure that you really want to, control your food supplies domestically, they came out in recent months with their 5-year plan from 2021 to 2025 at their plenum, talking about the need to focus on strategic assets, agriculture, commodities, crude oil, strategic metals, etc. And you've started to see this sort of replenishment, in their inventories. Their hog herd, which, as I mentioned earlier, had been decimated from African swine fever, has started to rebuild, and there has been torrid buying since really, midway through last year. We've seen crop prices, getting a lot of headlines right now. We're sort of close to 10-year highs in many crop prices, but yet we haven't reached points where we're starting to ration demand. Only yesterday, I think data came out saying China bought the second most grain that it ever has in history, even at these prices. You have exporters or these Chinese importers and other countries around the world, are fighting for demand with our own internal consumers, livestock, ethanol, biofuel industry. Our biofuel industry, in the case of biodiesel, continues to grow. So there's that fight for demand, and what that's left, what that's resulted in has been we're operating at pretty much close to pipeline stocks across most of the major producer exporters of the world, across most major crops. So we don't have a great setup right now. We're heading into this growing season with demand that is still very high. We have low pipeline stocks. And as you mentioned, you're seeing droughts in California, et cetera. But within the key grain producers of the US, we have droughts in the Northwest, Midwest. We have droughts in the Northern Plains, the Dakotas right now. And we haven't even hit the meat of the growing season when weather events and weather volatility really starts to kick in. And so right now, I think the risk reward, the setup is that this is a bull market that in agricultural commodities and ultimately, feeding through to how that impacts farmland that could last, through at least the end of 2022. The only way that we are going to stop this is if we have absolutely perfect weather across all the major producers going forward. And that will really just sort of maintain the status quo. It's not going to change anything. But if you absent that, we could continue to draw down stocks even more, or you need to have prices go to levels that start to ration demand. And we haven't seen that yet happen at $7 corn. So it's interesting how the tables have really turned, in the course of 6 months from something that was, really every headline being pretty negative to every headline being incredibly positive. And this is before we even start thinking about money coming into this market to satisfy the inflation play, for instance. So, you can talk about the Fed saying, do we believe that inflation is out of control or not? But every commodity, agriculture commodities, metals, lumber prices were up 370% year over year.
They're up either double or triple digits percentage-wise year over year.
They're up 230% right now, having fallen from up 370%. Home prices, the median price of a home is up 36 grand versus last year. You're seeing food companies, the Hormels, saying that we're going to be raising turkey prices going forward. J.M. Smucker talking about we're going to be raising, the price in peanut butter. And so, regardless of what the Fed says, all this money that's coming into the system, $12.3 trillion of stimulus over the past 13 months, and that's before, the next $6 trillion, that might come through the new budget. Inflation is here, and it's readily apparent. Inflation expectations are bid right now, and so I think, the confluence of all these different things is very supportive for ag in general.
Great. That's an excellent way to end this discussion. What you're saying there basically is, with your season perspective, you see a lot of tailwinds supporting ag prices from here, both the commodities themselves as well as the soils that grow them. Edward, again, thank you so much for coming on our conference here and sharing so much of your expertise. Very quickly, for folks that are interested in sort of learning more about agriculture, following developments there, or perhaps even following you, are there any sources that you recommend they check out?
So I think the easiest way, honestly, feel free to reach out over LinkedIn. And I'm happy to direct them any way they want.
Excellent. All right. Well, thanks so much for coming on, Edward. It's been a pleasure.
Thank you. Lovely being here.
We hope you've enjoyed this detailed discussion with farmland investor Edward Hargroves. If you find yourself now inspired to add farmland to your own portfolio, consider scheduling a free, no-strings-attached consultation with a financial advisor familiar with the options that Edward and I discussed in this interview. To do so, just fill out the very short form at wealthion.com and we'll help set one up for you. But before you do, please hit the like button and then click the subscribe button below if you haven't already, as well as that little bell icon right next to it. It only takes a second and it really does help us out, as the more subscribers this channel has, the more big name experts we can attract onto this program in the future. Okay, thanks for liking and subscribing, and as always, thanks for watching.